Don Luskin, let me go to you. What you've had here is a little bond market vigilanteism, it seems to me, telling a lot of these LBO deal guys, hey, you told us you were private equity, but it turns out you're just leveraging debt. That's all you're doing. So bond guys are saying and loan guys are saying, wait a minute, we're going to have to adjust for deteriorating quality and higher rates. It is a repricing thing. It is going to, in the long run, balance things out much better between debt and equity, won't it, Don?
You know, I think you're exaggerating a little bit the evils and the sins of the private equity business. If they've done anything wrong lately, they've just exploited an opportunity in the market to issue junk bonds at just extraordinarily low yields. But the key word in that is extraordinary. As you've indicated already, those yields have now risen back toward historical norms, and there's nothing wrong with that. It's perfectly reasonable for a private equity firm to want to take a company private with reasonable financing, because right now stocks are cheap versus forward earnings. Why wouldn't you want to finance that?
How cheap are they? How cheap are they, for instance?
Well, stocks are about as cheap today as they were at the panic bottom in October 2002 and again in the March panic bottom in 2003. And if you judge PE multiples versus interest rates, what I just said comes from an analysis where you look at them versus treasuries. But if you look versus junk yields, which even though they've puffed up in the last 10 days or so, they're still so much lower than their long-term historical values. They're so much lower than they were in 2002 and 2003. The valuation of stocks is just dirt cheap. It's crawling on its belly like a reptile compared to where it was in the panic bottom of October in 2002, from which the S&P has rallied about 100%.
Yes, indeed.
So,
yes,
so
indeed.
you gotta love them here, whether you're an individual investor, an institutional investor, or a private equity firm.
All right, John Brown, you gotta love them from here. That's what Mr. Luskin said. That's essentially what Mr. Stein said. What are you saying?
Well, it's a wonderful conjuring act, I have to say. All it's missing is the black top hat. I mean, one's had some wonderful statistics, and of course they all sound very good by cherry picking. But when you look into those statistics, it's a very different story. I mean, we've had good figures on the GDP, but when you look into it, what it is a sequential quarterly increase annualized to make up an amazing figure of annual growth. Looking in a lot of these statistics.
What do you mean there? So
that's how it always is.
The sequential increase was 0.8%, and they just multiply that up by 4, and rounding up, it comes to 3.3%.
That's how it's always done.
You've got to be kidding.
I know,
You've got to be kidding. It's a standard. It's a standard convention in
just let me tell you,
it's always done.
I know it's embarrassing to have the black cloth lifted from the conjuring trick, but the fact is, if you look at those quarterly,
that's how it's always done.
Well, let me just listen then. If you look
so
at those
divide by
quarterly
4, and then you're just going to divide history by 4.
I can't talk when you keep shouting in my head.
All right, John,
but
finish your point. Then I want Ben to weigh in.
If you look at each sequential quarterly figure, you'll find the trend is down, not up.
Well, actually, I would argue the trend is 2%.
But I actually think that both borrowers and lenders are in trouble. And what we're looking at is through the rearview mirror. The statistics that are coming out are for last month and the month before and the quarter and the year before. What we've got to do for viewers, I think, is look through the windscreen as to what's coming.
But the overall economy is phenomenally strong.
You're using the same black hat. The fact is the trend is down, even though an individual figure may be up this year. The trend line is down.
What do you mean? Hang on. What do you mean the trend is down? You're the one who 2 minutes ago said we shouldn't be looking at past data. What's a trend except looking at past data?
Well, I know that's right. The trend is, but that's a trend.
What data?
You're looking at a past trend.
What
is
data
different.
are you looking at?
Don Luskin, let me come to you. How do you play this whole market situation? How will we know, Don, that the corporate credit spread, quality spread issue is stabilizing and it's time to get on board for stocks? How do we know?
What we're looking for is an event like when J.P. Morgan strode onto the floor of the New York Stock Exchange in 1907 and announced that he'd put up a bid for anything and ended the terrible panic of that year. We need some bellwether, somebody to go in there and have the courage to get something done. So what we need to see is we need to see a private equity firm like KKR get one of its deals done. We need to see a broker like a Bear Stearns or a Goldman Sachs announce a share buyback, which tells you that they have great faith in their capital structure.
Isn't there quite a lot of that on schedule, though, Don? That's the one thing that did surface last week amidst all the turmoil. Corporate buybacks are still very much in the cards.
Right. I'm talking about buybacks from the parts of the corporate world that are most distressed right now, the investment banks, the people where capital is thought to be terribly scarce, where a lot of their core businesses are really seized up right now. They're frozen, they're not working, and that's a scary thing. So we need them to come in and say, we are open for business, we are working. It's really kind of like what it took after 9/11, when Wall Street got organized the week after and said, we are still in business, all our records are intact, all our systems are intact, we can do this. The bond market needs to act, we have that kind of courage, and you will see stocks spurt back to new highs. People will say, oh my God, what was I ever afraid of? This is ridiculous. The train's leaving the station and I want to be on it. That's coming.
All right, John Brown, what is your disagreement with these highly esteemed, very well-informed, clever, analytically smart gentlemen?
They are clever, analytically smart, and they're gentlemen. I totally accept that. But what an unfortunate analogy. It wasn't J.P. Morgan, but his stockbroker, Jock Whitney, who came onto the exchange and said, J.P. Morgan is buying U.S. Steel. And what happened? Short little uptick in the market, and then the market plunged to 1929.
Wasn't it J.P. Morgan?
I mean, what an unfortunate analogy. But
hang on a second.
Wait a second. If you're going to correct me historically, I would like you to repeat what you just said. So in 1907, we recovered from a panic, but then that didn't count because in 1929 there was a crash? Are you joking?
J.P. Morgan had to underwrite the Treasury bills with his own signature. I've seen him in Henry Morgan's office. But in 1929,
but there was 22 years of incredible prosperity.
Yes, I'm sorry.
Mr. Brown.
I thought you said. I'm sorry, I may be wrong, but I thought he said that Morgan came in and said he's buying U.S. Steel and buying stocks.
No, he didn't do it himself. But J.P. Morgan J.P. Morgan went to the White House. In 1907, J.P. Morgan went to the White House and told Theodore Roosevelt, he said, have your man talk to my man and we will fix it.
Well, all these gentlemen, and they are esteemed, and I didn't mean to be rude to that gentleman arguing. I thought he was talking about the great crash time, not 1907. But they are esteemed, and they're very good and analytical. But nearly all of them are very long of the market. And they have to talk, if they were to say anything bearish, their businesses would be severely hurt.
Are you saying that somebody who's either smart, works for a large firm, or owns stocks has to be bullish? I've seen Don Luskin change his views in and out, down through the years, so have I. John, that is really an unfair, cheap shot comment.
Well, I apologize for that, but it just seems to me, you know, I'm a little bear in this bull ring of very big, ferocious bulls, and I look at it and I see they manage or they're long of a lot of stocks. And so, isn't it a natural instinct to be bullish of things you're long on?
Hang on one second. Instead of impugning our motives, let's hear your analytical take.
But for right now, all the metrics tell us.
All right, well put. Don Luskin, I want John Brown, just a moment, please. Don Luskin, you get a last word response, please.
Well, what can I say? Ben's and my integrity is being attacked. The U.S. government's integrity is being attacked because we annualize GDP numbers. Mr. Brown, instead of attacking those who disagree with you, I would just like to hear one even slight rationale to justify your opinion. Let's hear it. What do you think? Go on record.
All right. One, if I were wrong and you were right, all three of you, why would the U.S. dollar be plunging in the international markets?
All right, hang on.
That has nothing to do with the stock market at all. Nothing.
You said the economy was good. You said the economy was good.
That has nothing to do with it.
All right, gentlemen.
You might as well be asking about Lindsay Lohan. That has nothing to do with it.
You say the markets are good. You say the stock market is good.